Hello, it's Mark Cunningham at Grace Property Management. If you're a Colorado real estate investor, a landlord, or tenant, let me explain to you why I believe, and we believe that the data shows that in 2024, we're going to see rents actually drop. We're going to see a reduction in rental rates in 2024. Now, of course, anything can happen. We're not making some bold prediction here, but we're trying to prepare for what to expect if you're a real estate investor in 2024 as it relates to your budgeting for the next year. So let me just share some basic reasons why we believe 2024 will be a year where rents may actually and will decline. It's at the end of the day, it's supply and demand. I remember in college taking an economics class, and it all comes down to supply and demand. And once again, as it relates to demand and supply, that's why we believe rental rates will decrease. So let's look at those two things just a little bit, the supply side and the demand side. Rental supply, the number of rental properties on the market is increasing very, very quickly. And a couple examples of that. Number one, short-term rentals are converting from short-term furnished rentals, think of VRBOs, they're converting to long-term rentals. Now this is happening for a number of reasons. The numbers aren't there. The demand for short-term rental properties is greatly reducing as compared to where it was during COVID. You also have places like Denver that are greatly reducing the ability to offer a short-term furnished rental. They're just taking it away, they're requiring licensing, they're minimizing the numbers that can come in. So a lot of individuals who own short-term furnished rentals are calling companies like ours, and they're saying, hey, I want to long-term rental this thing. Can you manage this for me? Which of course we do, but that's a new part of supply coming on. So we've got a supply increase there. Secondly, we have a huge new pool of investment properties, single-family homes primarily, with sub 3% interest rates. So during COVID, interest rates were low. A lot of homeowners refinanced and they got an interest rate of 2.99. And they have no intention of being a real estate investor. They're moving out of the state, they get a job transfer, a life situation happens where they're moving out of that property, and they look at that interest rate of 2.99% and they think, I don't want to give that up. That's too good. I'm going to hold on to that. I had no intention of being a real estate investor, but I am now. And they're converting that property to an investment property, which adds to more supply. Third, new multifamily supply. A lot of new multifamily is coming out of the ground, being built. Now you say, well, Mark, I own a single family home, so that doesn't impact me. It really does at the end of the day, because it drives prices down potentially. And some of these new multifamily properties are so nice that someone who previously would have gone and rented a 3-bed, 2-bath house with a garage, now they can rent a very large Class A multifamily 3-bed, 2-bath with underground parking and a swimming pool in the complex and a weight room and a dog park. So they really are pulling people out of the single family demand into the new multifamily demand. This is a screenshot of a Wall Street Journal article from just a week ago. It said luxury apartment glut in South Florida offers some price relief. Now you say, well, that's South Florida. What does that have to do with us? Which is a great question. But one of the things in the articles, they shared this stat. They said in all the major metropolitan markets in the United States of America, which of those markets have the most new supply of multifamily coming into their inventory as it relates to existing supply, if that makes sense. And so South Florida, Miami was number one, meaning 17%. So the current group that's there, the current numbers is being increased by 17%. Well, guess where Denver ranked? 1, 2, 3, 4, 5, 6, 7. Of all the metros in the United States, Denver is the 7th highest percentage of new supply coming on as it relates to current, 12.2%. That means our inventory is being increased by 12.2% in the multifamily space. That's a huge number. That means for every 100 units that are here now, 12 new ones are coming, or are just like coming now, like they're here. 12%. That's a massive number, which increases supply dramatically. Let me give you some numbers on that. 46,000 multifamily units are now under construction just in Denver, and 75,000 more are in the pipeline. We do not have a demand problem. We have a lot of supply. There's too much supply, in our opinion, coming on board. That's going to push prices down, supply and demand. Now, at the same time, we have supply going so high up. New supply, new supply, new supply. At that same time, we have demand actually decreasing. We have less people moving to Colorado from a number standpoint than we have had the last couple years. It doesn't quite have the attraction that it did during COVID. We have less people coming on board. We have inflation impacting renters significantly. Everything costs more. In August, Denver had the highest CPI increase in the nation as it relates to major metros. Highest in the nation. That means when you drive through the fast food place to get your hamburger, you're spending more on your hamburger, you're spending more on gas, you're spending more at the grocery store. So tenants are spending more of their money on other things. They don't have a lot of money left over to upgrade their rental housing because everything else is costing more, which is kind of number two there. They have less money to spend on rent. And a big part of that is student loans. So for the last 3 years, the federal government has deferred student loan payments. No more. They are now requiring all the people with student loans to start making those payments again, which for all of them is going to be several $100s a month more. That's a new expenditure they haven't had for 3 years. That's $300, for example, out of their pocket spent on student loans that they don't have to spend on rent. So what are they doing? A lot of people are doubling up. We're just not seeing the demand come in. We're recording this video here in early October, and the market always slows in October. Demand for rentals slows in October. But this year has been the biggest increase in demand we have seen probably in the last 15 years. The biggest reduction in supply, the biggest reduction in demand. They just aren't there. Tenants are not demanding rental properties like they were for last year and the year before that. In the past, in the last really 15 years, you put a house up for rent and 10 people immediately get in line and say, I want to rent it. That's not the case anymore. Now we put a property for rent and maybe we'll have 1 or 2 people in line saying, I want to rent it. And by the way, the quality of the applicants' credit scores are a little bit lower than they have had in the past. Let me show you a couple of recent headlines to back up what I'm saying. This is the Denver Post. Their headline was, already facing a glut of office space. We have a glut of office space as well. Already facing a glut of office space, Denver may soon find itself with too many apartments. What happens when supply goes up? Demand goes down and prices come down to fill that stuff. Apartment markets, this was the University of Denver. Apartment markets are in the early stages of hypersupply. Yikes, that's scary if you're a real estate investor. Hypersupply means it's hard to find tenants, which leads to the next headline. This was a senior VP at CBRE. Listen to this scary thing. He said, there will be a knife fight for tenants over the next 24 months. That means as property managers, as landlords, no longer are we looking at a line of 10 prospective tenants picking the best one we want. Now we're fighting for them. A knife fight. Gosh, that's a little bit scary, but that's what they're predicting as they look at the data out 24 months. Here's one more. This was Wall Street Journal. Many of these new buildings are offering 1 or 2 months free rent. Other concessions include smaller deposits, which in some cases have been slashed by more than 80%. So if you've got a property and you're trying to rent it, what do you do? How do you increase the demand? Well, one thing you can do is offer a concession. 1 to 2 months free are what these multifamily properties are doing. And at the end of the day, we have to compete with that to get properties rented within our portfolio. And you have to compete with that to make sure you're attracting those individuals because they have a lot of opportunities and a lot of rental offerings right now. Here's average year over year rent growth anticipation. This was put up by the Apartment List. They anticipate Denver will drop, average rents will drop by 1% overall. Colorado Springs has dropped 5.7%. And excuse me, this is not a projection, this is current. This is current year over year. So Denver right now, rents are down 1% as compared to where they were a year ago. Colorado Springs is down almost 6% from where it was a year ago. And you say, well, Mark, that's 1% is irrelevant. The important thing to remember is that average rents don't take into consideration concessions. So when a landlord has a vacant property and they offer a month free, for example, that landlord just lost 1 month of rent, but the average rents didn't change. They do this in the multifamily world often. So it's a way to kind of manipulate the statistics a little bit. So when you actually factor in concessions, that 1% is more like 7% because they're also offering a month free on the front end just to get the property filled. So rent is down, but they're also giving 1 or even 2 months free, which they weren't doing a year ago. So you say, well, Mark, that's gosh, that's that's scary. What do we do as landlords? Well, let me offer you 5 suggestions if you're a real estate investor on how to make sure that your property gets rented quickly, how to encounter and combat this. Number 1, your property, when it turns over, it's got to be very clean, very updated, and it's got to show well. It's got to be competitive. Gone are the days of just putting a for rent sign in the front yard and having a bunch of people who want to rent it regardless of the quality of the property. Quality matters, cleanliness matters, the property's got to be clean, updated, and show well. That's number 1. Number 2, the marketing on that vacant property must be very, very effective. You can't just put an ad on Facebook and hope it's going to get rented. It's going to require things like video tours. You're going to have to post that on a lot of paid sites. Zillow has a premium paid platform, which we utilize. If you're a client of ours, we put that on the paid Zillow site as well to get higher rankings in Zillow, so more eyeballs see that property of tenants out there looking. Marketing is very important. If you're a client of ours, don't worry. We do all that for you to make sure that we're pushing out our properties to the maximum people looking. Number 3, the pricing has to be aggressive. Aggressive pricing because you've got to attract people. We're seeing rents right now less than they were 12 months ago. So the question isn't how much more rent can I get on my new tenant that I got on my last one. The question may be, how low do I need to go to get this property rented to a quality tenant? How much further under last year's pricing do I need to come? Number 4, your applicant screening and security deposit must be realistic. You may have to drop the bar a little bit on the quality of tenants that you require to approve. Because when you have 10 people applying, you can raise the bar because some of those are going to be very high quality. When you have 1 person applying, or maybe 2, you've got to be realistic in your security deposit requirements and your applicant screening. It's got to be balanced. You still want to make sure that you're only allowing quality individuals into the property, but you've got to change that bar, which, by the way, we talked about last month. For subsidized tenants, landlords may no longer look at their rental score or may no longer look at their credit score. Credit scores are irrelevant. It is illegal for us to look at that on subsidized tenants. Go watch last month's video for more information on that. And then number 5, and this is most important, avoid turnover. If you are an owner client of ours, please know that in 2024, our biggest focus for you is to avoid turnover. Keep good tenants in place. That means we need to be effective in taking care of them while they're here, fixing things when they break, keeping them satisfied and happy, and at the same time, not pushing big rent increases, or maybe not pushing any rent increases at all. Why? Because we want to avoid turnover next year. Turnover is the biggest expense you potentially have as a landlord. It leads to vacancy, it leads to expenses, and when you bring the new tenant in, you may be bringing them in at a lower rate than your prior tenant went out. So if you're an owner investor of ours, know that we will be focusing a lot on avoiding turnover for next year. If you're not an owner client of ours and we can be a resource, please feel free to jump on our website, rentgrace.com. We're happy to help if we can. I wish you success.